The US Treasury yield curve is on the brink of a significant shift, and it could steepen to its widest point in 4 years if President Donald Trump's latest Federal Reserve nomination goes through. This development is stirring interest among market watchers and economists alike. But here's where it gets controversial. The potential impact hinges on whether Stephen Miran, the current chairman of the Council of Economic Advisors, secures the Senate's approval to join the Fed as a governor. Strategists at JPMorgan Chase Co. have highlighted that the gap between yields on 5-year and 30-year U.S. Treasury bonds expanded noticeably following Trump's announcement of Miran's nomination. This spread, or difference in yields, is a key indicator of investor expectations about future economic growth and inflation. A steeper curve generally suggests optimism about long-term growth prospects or rising inflation expectations, which can influence everything from mortgage rates to corporate borrowing costs. Interestingly, this nomination comes after reports suggested that Christopher Waller, a sitting Fed governor, was the front runner to replace Jerome Powell as Fed chair. This creates a fascinating dynamic within the Trump administration's approach to shaping the Federal Reserve's leadership and future policy direction. And this is the part most people miss: how these appointments could dramatically reshape monetary policy and market behavior in the months and years ahead. The Senate's confirmation process will be closely watched, with investors debating how Miran's perspectives might contrast with or complement those of current Fed officials. Could a steeper Treasury curve signal a new phase of economic growth, or might it ignite concerns about inflation overheating? This question is bound to spark debate. What's your take on the implications of Trump's Fed picks? Do you believe this will stabilize markets or add volatility in uncertain times? Share your thoughts and join the conversation.